Hello, hi guys. Sorry for the delay. There was some, internet issue I was facing. So, welcome to the class. Today is the first class of bar, and I believe that all of you who are attending this class must have done FAR, right? Um, just can you quickly confirm in the chat box? Have you already done FAR? Just say yes or no. Okay. So if you have not done FAR, then you might face some amount of difficulty in bar, because this is kind of an extension of, as far as like some topics are concerned, it is an extension of FAR, right? So I'll quickly give you a background of bar. Basically, it is a mix of certain erstwhile business environment and concept BEC topics and uh, some FAR topics, right? So it's a mix of Beck and FAR. But the portion that, the portion of FAR that is there in bar is the more advanced or the more complex topics, which were earlier in the FAR paper. Now, earlier FAR paper had 10 chapters. Now the FAR paper in the new syllabus has only 6 chapters, right? So the FAR syllabus has gone down and some topics from FAR have been now moved to bar, okay? So the more complex topics have moved to bar. Okay, so you need to have that background to be able to do at least the finance and accounting related topics of bar. So if you have not done FAR, then you might face a little bit of difficulty. Having said that, it is not impossible. What you just need to do is probably go through the relevant topics of FAR, before you come for the next class of bar. Okay. So I'll tell you, I'll show you, just give me 1 second. I'll show you what topics are there in bar and you can decide for yourself. The ones that I'm going to cover, at least in the coming 2 weeks. So I hope you can see the screen. Can you see the screen? Yes. Okay. So intangibles with indefinite lives, revenue recognition, advanced topics, right? Revenue recognition, advanced topics. That means obviously you need to have the basic knowledge of revenue recognition. Then you have stock compensation. Then you have business combinations and consolidated financials. So to do consolidated financials, again, you need to have the basic knowledge of, the acquisition method. So in the FAR syllabus, we have covered the FETNI, we have covered equity method of accounting, and we have covered acquisition method of accounting, right? Then you also have foreign currency translation adjustments here. Foreign currency translation is fine. I mean, it's pretty much a standalone topic, although it falls under consolidated financials, but this is a topic that you can probably understand even without going through FAR, right? Derivatives and hedge also you might be able to understand without going through FAR. Leases you will not, because leases we have done some bit of leases there. Then you have segment reporting, public company reporting topics. This is also fine. You can do it without going through FAR, and employee benefit plans is also fine. So I would say, go through the revenue recognition part, the basics of consolidation, right? And leases. These three, I'll write down, I'll just circle it here. This one, the basics of consolidation, and the leases module. This much at least you need to know before, coming here. And so don't worry, today I'm not going to cover, all of this. Today is more like an introductory class. I'll also quickly walk you through the FAR syllabus, just to show you the topics that we have covered in FAR. Okay, so that you know exactly which videos to watch. Just give me one moment. I will also share the other one. This is bar 5. The earlier one which I showed you was bar 4, right? I'm going to do bar 4 and 5 with you because those are the finance and accounting related topics. Bar 1, 2, 3 are the erstwhile Beck topics which Abhinav sir is going to take. Okay, so B5, can you see B5 on my screen? Can you see B5 on my screen? Yes. Okay, so now if you see here, this is complete governmental accounting, right? For this, you have to go through the FAR governmental accounting topics. Otherwise this will not make much sense to you, right? So you need to know what type of funds are there, right? Like, the governmental proprietary fiduciary funds. In governmental you have grasp funds. In fiduciary you have in proprietary you have S&E, the internal service fund, and the enterprise funds. And then in the proprietary in the fiduciary you have the SIPO funds, right? So GRSPP, then the SNE, and the SIPO, CIP and POE funds. So there are 3 categories. Under those 3 categories, there are 11 types of funds. And, so of course I will talk about that, but I'm just telling you right now that you need to go through that to be able to understand this better. Okay, so I'm going to cover bar 4 and bar 5 with you, B4 and B5. So for B4, I've already told you these are the 3 topics. For B5, you need to go through the governmental topics. Okay, in the FAR syllabus. Now, let me quickly show you the FAR syllabus for people who have not seen it at all. All right, so I'm again sharing the screen here. Okay, so let me quickly walk you through all of them. So F1 has these basic topics: balance sheet, income statement, comprehensive income, EPS, earnings per share, and public company reporting topics. Now, if you see here, there is public company reporting topics, and in bar 4, there was public company reporting topics. Okay, so you need to go through that, right? So you need to go through this one. You can write down, people who have not done FAR, you can please write down F1, M2, F1, module 2, go through that. Then stockholders equity part 1, part 2, you can probably skip for the time being. Then coming to F2, revenue recognition, you have to go through. Yeah, at least revenue recognition for the time being. Okay. Yeah. Then let's come to F3. So you can do intangibles with finite lives, because we are going to cover intangibles with indefinite lives over here. Right? So intangibles with indefinite lives, we are going to cover over here in bar. In bar. In far, we have already covered intangibles with finite life. Right? So you may want to note this down. This is F3 module 6. Right? This is FAR 3 and module 6. Okay, guys? Then F4. In F4, you need to at least cover this lessee accounting. Right? Because we are going to cover leases over there. So this is F4, module 7. Then moving on to F5. In F5, you may want to do financial instruments, right? And consolidated financial statements. So M1 and M3, yeah, that's it. And in F6, governmental accounting, 5 and 6. Okay. So once again, very quickly, F1 module 2, F1 module 2, F2 module 1, okay, F3 module 6, F4 module 7, F5 module 1 and 3, and F6 module 5 and 6. These modules, go through them, in the coming week, so that during the coming week, so that in the next weekend's class, you are up to speed with what we are covering here. Okay, this weekend, don't skip the class, attend the class, but during the week, make sure that you go through these topics that I just told you to. Okay. Can I get a quick sense of how many chartered accountants are there in the class? 2, 3, 4. Okay, just 4 people as of now. All right, 5. 5 people. Okay, fine. Okay, so let's get started then. Intangibles with indefinite lives. Okay, now one thing, I'm going to cover only bar 4 and bar 5. So you must have got this, received the schedule for bar 4 and bar 5, right? And then the rest of the topics will be covered by Abhinav sir. So the schedule that you might have received right now is only for bar 4 and bar 5, right? Not for entire bar. All right. So this is the first module, intangibles with indefinite lives. Now, before I go through this, let's quickly glance through, for the benefit of those people who have not done FAR, indefinite intangibles with finite lives. Let's quickly glance through this. Okay, page 59. So here we had the definition as intangible assets. What are intangible assets? They are long-lived legal rights, competitive advantages developed or acquired by a business enterprise. Developed or acquired. They are typically acquired to be used in operations of a business and provide benefits over several accounting periods. Now, couple of things here. Intangibles, developed or acquired. So this is the classification of intangibles. Depending on the manner of acquisition, the classification is they are either purchased or internally developed. Depending on the manner of acquisition, this is the classification: purchased or internally developed. The purchased intangibles are recorded as an asset, right? So they should be recorded as an asset at cost. The legal and registration fee should also be capitalized. So the ones that are purchased are capitalized, and obviously capitalized and therefore amortized. Right? So they are capitalized and amortized. Now, of course, whether they'll be amortized or not will depend on whether they have a definite life or an indefinite life, finite life or an indefinite life, right? So amortization will happen only in case of finite life intangibles. Now, internally developed are expensed, because US GAAP prohibits the capitalization of R&D costs. Okay, US GAAP prohibits the capitalization of research and development costs. And this is a development cost. You're internally developing, right? So research and development costs are expensed. So trademark, goodwill, cost of developing, maintaining, or restoring goodwill, all this is expensed under US GAAP. Of course, there's an exception. There is an exception. The exception is that certain costs can be capitalized, like legal fee and other costs related to successful defense of the asset. Successful defense, if somebody has filed a case and you have won the case, right? You have successfully defended your case, then the legal cost can be capitalized. But if you lost the case, unsuccessful defense will be expensed. Okay. Then of course, registration fee or consulting fee can be capitalized. Design cost can be capitalized, for example, of a trademark, and other direct costs to secure the asset. These fall under the exceptions, right? These are exceptions where these costs can be capitalized. Otherwise, the general rule is that internally developed intangibles are expensed, right? So when they are expensed, there is no question of amortization. Amortization will obviously happen only when it is capitalized, which is in the case of acquired intangibles or purchased intangibles, right? This much is clear to everyone. Simple concept. Now, expected period of benefit. Now, this is where, the finite portion has been covered in FAR, the indefinite portion has been covered in BAR. Now, don't ask me why, but this is how it is, right? Finite portion has been covered in FAR, indefinite life has been covered in BAR. So classification of intangible depends on whether economic life can be determined or is indeterminable. See, we are not using the word infinite, right? Because nothing in this world is infinite, right? So we are using the word indefinite. We just don't know how much its life is. Okay, it is indeterminable. An intangible asset has a finite life when it is possible to estimate the useful life. It is not possible. If it is not possible to determine, then the asset has an indefinite, not infinite life. Okay, it has an indefinite life. Now, the problem with that is, if we don't know how much the life is, then over what period will you amortize it? Isn't it? Over which period will you amortize it? Will you amortize it over 5 years? Will you amortize it over 7 years? Will you amortize it over 10 years, 15 years? You don't know. It's a question mark. We don't know. So therefore, the treatment is different. When you know the life, you can amortize it over that life. But if you don't know the life, over which period, over how much period will you amortize it? So therefore, the treatment is different. Then also comes the question of separability. Classification of intangible asset depends on whether the asset can be separated from the entity, also referred to as specifically identifiable, like patent, copyright, franchises, etc. can be separated, okay, or is substantially inseparable, which is called specifically not specifically identifiable. And here typically the intangible that comes under this category is goodwill. Okay, even trade name can be an example, trade name or goodwill. Right, so specifically identifiable intangibles and not specifically identifiable intangibles. Right, so categorization, one type of categorization is whether it is purchased / acquired or internally developed. One type of categorization is with respect to its life, whether it has a finite life or indefinite life. And the third type of categorization is whether it is specifically identifiable or not specifically identifiable. So these are the three different types of categorization. Whether it is purchased or internally developed will tell you whether to capitalize it or to expense it, whether to capitalize it or to expense it. Finite or indefinite will tell you whether to amortize it or not to amortize it or not, right? And specifically identifiable versus non-specifically identifiable will help you in impairment decisions, because goodwill impairment has a different treatment than the impairment of other intangibles which are specifically identifiable. And here also, the ones that are amortized will also be tested for impairment. The ones which are not amortized will only be tested for impairment. That means finite life intangibles will be amortized, plus they will be tested for impairment. Indefinite life intangibles cannot be amortized because we don't know which period to use. So they will only be tested for impairment. Okay, so this finite or indefinite will help you in determining this. Purchased, acquired, or internally developed will help you in determining whether to capitalize or expense it. And obviously, if you capitalize it, only then the question of amortization comes. If you expense it, there is no question of amortization, right? And finally, specifically identifiable will have a different impairment, different steps for impairment. Not specifically identifiable, which is typically goodwill, will have a separate impairment testing procedure. So this is the crux kind of so far. And I'm still on the FAR topic here, just for the benefit of those students who have not done FAR, right? I'm quickly spending here because today is the first class and maybe tomorrow. From the coming week, I will expect you to already know these topics before you come for the bar class. Is that fair? Is that fair, guys? Because obviously I can't repeat the FAR topics in the bars, bar timing. Today, because it's the first class, I'm doing it for your benefit. Capitalization. So obviously, if you have to capitalize it and you will capitalize it at cost, so you need to know the cost. Cost is measured by how much you have paid for it, right? Cash disbursed, or if you have given some asset, then the fair value of those assets distributed. If you have incurred some liability, then the present value of the amount of liability. And if it is for stock issued, stock here obviously means shares, then the fair value of the consideration received for the stock issued. This is how you measure the cost. And once you know the cost, then you can determine the amortization. Cost may be determined either by the fair value of the consideration given or fair value of whichever is more clearly evident. I'm not going into too much of detail right now because this is already covered in FAR. So amortization, the value of intangible assets eventually disappears. Therefore, cost of each type of intangible except goodwill and assets with indefinite lives should be amortized, right? Goodwill will be impaired So in US GAAP, goodwill is not tested for, goodwill is not amortized. It is only tested for impairment. The only exception to this rule, guys, anybody who have attended FAR recently, what is the exception to this rule? Does anyone know what is the exception to this? So what I'm saying is that goodwill is not tested, not amortized. Under US GAAP, goodwill is not amortized. Okay, of course, I'm not talking about the Private Company Council rules. I'm not talking about the PCC rules. Okay, created by the Financial Accounting Foundation, FAF. I'm not talking about this. I'm talking about the general rule. Goodwill is not amortized. Goodwill is tested for impairment. Am I right? I'm talking about US GAAP. I'm not talking about IRC rules. I'm not talking about income tax rules. And also, I'm not talking about the Private Company Council PCC rules. I'm talking about the general US GAAP rule. Goodwill is not amortized. Goodwill is tested for impairment. Now, my question to you is, what is the exception to this rule? Anybody? Come on, guys. People who have done FAR. In which case, goodwill is not tested for impairment also. It is not amortized and it is also not tested for impairment. Deepak Agarwal, you are on the right track, but what is the name? Okay, nobody's answering. So I'll tell you, it is basically the equity method of accounting, the equity investment, right? It is the equity investment where the goodwill is not tested for impairment. It is neither amortized nor tested for impairment. The entire equity method investment is tested for impairment. Right? The goodwill is not tested for impairment separately. The entire equity method investment as such is tested for impairment. Right? So this is the only exception. Otherwise, goodwill is, under the normal US GAAP rules, goodwill is not amortized. It is tested for impairment. Okay. So that is what it is saying over here. Except goodwill and indefinite life intangibles. Except these, the other intangibles, that means basically the finite life intangibles, are amortized by systematic charge to income over the period estimated to be benefit. That means amortized over the useful economic life. And the method is straight line. And if there's a change in useful life, that will, the remaining book value is amortized over the remaining life. That means basically prospectively, right? Change in useful life is change in estimate. So it is treated prospectively. You will not go back and do any retrospective adjustments. You will take the remaining net book value and amortize it over the remaining life. That means basically the treatment is prospective, right? Now we just saw that amortization happens over the estimated economic life. If you see the passkey here, there's an exception to that rule. A patent is amortized over estimated life or remaining legal life, whichever is shorter, right? Estimated life or remaining legal life, whichever is shorter. That is in the case of patents, because patents have a legal life, right? So whichever is shorter. And then if you sell an intangible asset, then of course the gain or loss is taken to the income statement, right? And in the balance sheet, intangible assets are reported the finite life intangibles, are reported at cost less amortization and impairment, right? Like I said, for finite life intangibles, they are amortized as well as tested for impairment. Indefinite life intangibles are only tested for impairment, so their reporting is cost less impairment, right? So finite life is cost less amortization and impairment. Indefinite life is only cost less impairment, right? There's no amortization. And then impairment of finite life intangibles. It's a two-step impairment testing. Step one, you compare the carrying amount with the undiscounted cash flows. And in step two, you compare the carrying amount with the fair value. But of course, you come to step two only if step one shows impairment. Okay. That means basically what I'm saying is, suppose the carrying value of an intangible is 100 and the undiscounted cash flows is 120. Then there is no impairment. You don't even have to go to step two. You will stop at step one. But suppose carrying value is 100 and undiscounted cash flows is 80. Now you know that there is impairment, right? Then you go to step two and you compare the carrying value of 100 with the fair value, which let's say is 70. So now you know that impairment loss is 30. So step one only helps you in determining whether to go to step two or not. Step one does not tell you the impairment calculation. It does not tell you the impairment loss. It only tells you whether you need to go to step two or not. So step one, in the first scenario, you don't need to go to step two. There is no impairment. You stop here. You don't have to do anything. There is no impairment. In scenario two, in step one, you know that there is impairment. You are showing the asset at more than its undiscounted cash flows, right? So you now need to bring it down. So in step one, you just know that there is impairment. So you go to step two and you calculate the actual impairment loss in where you compare the carrying value with the fair value of the asset, and fair value generally is PVFCF. That means present value of future cash flows. Present value of future cash flows is also known as fair value, although fair value could also be different sometimes, because if you have done the fair value topic in FAR, then you know that fair value, there is cost approach, income approach, market, one second. There is market approach, income approach, and cost approach, Mike, right? So there could be different approaches, right? One of the approaches is PVFCF. The income approach is PVFCF. So if you use the income approach in determining fair value, then PVFCF is equal to fair value. But if you're using some other approach in determining fair value, then fair value could be different from PVFCF. Okay, so that you don't worry, question will tell you. Okay, that you don't have to worry. Question will tell you which approach they have used or whether PVFCF is the fair value or not. They'll give you enough hint to determine that. The point is that step one only helps you in determining whether to go to step two. Once you go to step two, you calculate the CV with the FV, carrying value with the fair value, to determine impairment loss. If the question has given you CV and PVFCF and nothing else, then obviously they are trying to hint out at you that PVFCF is fair value, right? So you get impairment loss. Now, pass key, it is important to note the following when testing an intangible with a finite life that determine the impairment using undiscounted. It's the same thing that I just explained. First is determine whether there is impairment or not. For that, you use undiscounted future net cash flows. And when you have to calculate the amount of impairment, you use the fair value, right? So this is basically step one, where you are comparing carrying value versus undiscounted cash flows. And this is step two, where you are actually calculating the impairment and you are comparing carrying value versus fair value. Make sense? Impairment loss is reported as a component of income from continuing operations before income tax, unless impairment loss is related to discontinued operations. So obviously, if it is related to discontinued operations, it will be shown in the discontinued operations section of the income statement, right? If it is related to discontinued operations. So by the way, why don't you also then do the discontinued operations module? So I'll just tell you which module it is, right? Otherwise it is shown as component of income from continuing operations, right? Unless it is part of discontinued, in which case it will be shown under discontinued operations. Okay. Carrying amount of asset is reduced by the amount of impairment loss. Restoration is prohibited. Restoration prohibited unless the asset is held for disposal. That means once you have brought it down, for example, from 100 down to 70, you cannot take it back to 100. You cannot. Restoration is prohibited unless it is held for disposal. If it is held for disposal, then you can restore it. But if it is held for use, the intangible, I'm talking about obviously the intangible, if it is held for use and it has impaired down to 70, then you can't bring it back to 100. But if the intangible was held for disposal and you had brought it down from 100 to 70, you can bring it back to 100. You can do it. Okay. So once again, same thing here. You are comparing the carrying value with the undiscounted future cash flows. That means this is step number 1. Correct? And now if it is positive, positive means the future cash flows are more, then there is no impairment. There is no impairment. But negative means future cash flows are less, carrying value is more, right? That means there is impairment. Now you have to see whether the asset is held for use or held for disposal. If it is held for use, restoration is not permitted. If it is held for disposal, restoration is permitted. And the calculation is, now you are comparing carrying value with fair value, and the difference is impairment loss. Here also you are comparing the carrying value with the fair value, and the difference is impairment loss. But because it is held for disposal, the cost of disposal will also be added to calculate the total impairment loss. That's the only difference. So example over here, carrying value is 900,000. Future cash flows are 1 million. So step 1, future cash flows are more. It's a positive number. The difference is positive. That means future cash flows are more than the carrying value. There is no impairment. No impairment means you don't have to go to step 2. You don't have to do anything. You are just fine. You don't have to do anything, right? Another example, carrying value is 1.2 million and the future cash flow is 1 million. Now there is impairment because future cash flows are less, carrying value is more. So now you know that you need to go to step 2. Okay. So step 1, undiscounted cash flows, carrying value is more, right? So it will be a negative number, 200,000. Negative number means there is impairment. Okay, forget the sign, negative, positive. Basically, if carrying value is more than the undiscounted cash flows, there is impairment, right? Whether you write CV minus UCF or you write UCF minus CV, that's a different matter. That, I'm not bothered about that. What I'm bothered about is, are you applying the concept? Concept is, if the carrying value is more, then there is impairment. Okay. So here carrying value is more, 1.2 million. UCF is 1 million. So there is impairment. Now you need to go to step 2. Now in step 2, you need to basically bifurcate into two parts, whether the asset is held for use, I'm writing in short, or it is held for disposal, right? So if it is held for use, then you simply do, this is asset held for use, the FV or the PV FCF, present value of future cash flows. See, FV slash PV FCF, that means it's the same thing, 700,000. So now you know that carrying value is 1.2 million and PV FCF is 700,000. So impairment is 500,000. In this case, it is also 700,000. And this is 1.2 million carrying value. So -5. And there is cost of disposal also. That means total impairment loss is 600,000. In this case, restoration prohibited, right? And in this case, restoration is permitted. Pardon my handwriting. I hope it is legible. You can read what I'm writing. And if not, then answer is here. Impairment is there. Now you go to step 2. Oops, sorry. 500 and here it is 600. Here restoration is prohibited. Not permitted means prohibited. And here restoration is permitted. Clear? So this much you needed to know. Now let's go to bar. Intangibles with indefinite lives. Okay. So let's start. So intangible assets are long-lived legal rights and competitive advantages developed or acquired by a business. Intangibles may be either specifically identifiable, like patents, copyrights, franchises, or not specifically identifiable, like goodwill. May have a finite life or an indefinite life. If there are no contractual, legal, economic, or other factors which limit the useful life, it is deemed to have an indefinite life. Most common indefinite life intangible is goodwill, right? So goodwill is the most common indefinite life intangible. Okay. Carrying amount of an indefinite life intangible is equal to cost to acquire the asset less impairment. No amortization, right? No amortization. It is cost less impairment. Amortization is not relevant as indefinite life intangible assets do not have a useful life over which to amortize, right? Simple. Goodwill arising from business combinations. Goodwill represents an intangible resource and elements connected with entity that cannot be separately identified and reported on the balance sheet. Goodwill represents excess earnings power. Goodwill that is generated internally or is not purchased in an arm's length transaction cannot be capitalized as goodwill, right? So internally generated internally are expensed. Goodwill arising from business combinations is recognized as an asset on the balance sheet because you are now purchasing it in an arm's length transaction, right? So basically, goodwill arising from business combinations is recognized as an asset. So that means basically we are talking about this scenario, right? Generated internally is expensed. Now, acquisition method and equity method. What is the difference, guys? People who have done FAR, can anybody tell me what is the difference in the calculation of goodwill under acquisition method versus equity method? Anybody? Mhm. Okay. Okay, Premdeep, I've seen your answer. Shivangi, your answer is, uh, so you're basically telling me what is the difference between acquisition method and equity method. My question is, what is the difference between acquisition method goodwill calculation and equity method goodwill calculation? Right. So Shivangi, your answer is not right. Okay, I will tell you. So I need a blank page. So let me just go up. Yeah, I can use this space. All right. In the equity method, right, it is the purchase price minus the fair value of the net assets acquired. Correct? Whereas in the acquisition method, also it is the purchase price minus the fair value of net assets acquired. But the difference is this includes identifiable intangibles. Of course, identifiable intangibles that were not part of the investee company's balance sheet. That were not part of the investee company's balance sheet. So here basically we are talking about only B and G. Here we are talking about B, I, and G. Does it ring a bell? This is the book value to fair value difference, or yeah, whatever, book value, fair value, or fair value, book value. Basically the difference between fair value and book value, right? So book value, fair value, or fair value, book value difference. And whatever is remaining was goodwill. But here it was book value, fair value difference. Then identifiable intangibles. And then whatever is remaining was goodwill. Right? Am I right? Guys, are you not revising? Okay. I'm reading the equity method first. Under equity method, which is used as investor company exercises significant influence over investee company, goodwill is excess of purchase price over fair value of net assets acquired. Purchase price and fair value of net assets acquired, the difference is goodwill. Under acquisition method, it is the acquired entity's fair value over the fair value of entity's net assets, including identifiable intangibles. And of course, the purchase price is assumed to be equal to the fair value, right? So you have paid the fair value to purchase the investee company. So purchase price or fair value minus the fair value of the entity's net assets. But here it includes the identifiable intangibles that were not part of the balance sheet of the investee company. They were outside the balance sheet, off balance sheet item. Yes. Yes or no? Yes, right? All right. Deepak, you want me to repeat it once more? All right, just give me 1 second. Let me go back up here. Equity method. You invested in 30% shares of this company. Let's say the book value of the net assets, right? You know why I'm drawing it like this? Because this is asset minus liabilities. That means net assets, right? So net asset means basically the car. Basically, it means the stockholders equity section, right? Which is basically the car. Now, if the net assets is, suppose it is 1,000, you are acquiring 30%, but you have paid, let's say 350. You have paid 350 to acquire 30%. The net book value of the net assets is 1,000. You have acquired 30%. That means you should have paid 300. Why have you paid 50 more? You have paid 50 more because of the fair value to book value difference in the assets. So suppose the fair value of these assets, the net assets I'm talking about, the fair value is suppose 1100. Now, if it is 1100, your per share comes to 330. Now you have paid 350. Why have you paid this 20 extra? For goodwill, right? That means if I break this up, 350, you paid 300 for the book value of the net assets. You paid 30 extra for the fair value to book value difference. You paid 20 extra for the goodwill. So total you paid 350. Correct? But in the acquisition method, now you have invested, let's say 100% in this company. Now suppose it is 1,000, but you have paid 1,400. Why have you paid 1,400? 1,000 into 100% is 1,000. So you have paid extra because of the fair value. So the fair value is 1,100, as I said in the previous example. So let's continue with that. Now you have 100% of that. So 1,100 into 100% is 1,100. But you have paid 1,400. Now suppose they had some intangibles, identifiable intangibles, which were not part of their net assets. That means it was not part of their assets. It was not reflecting in their balance sheet. Does anyone remember what kind of examples were there for identifiable intangibles not in the balance sheet? Yes. Ishita, why would these not be there in the balance sheet? Premdeep, yes, your answer is correct. Correct. Ishita, why would the answers that you have given, why would they not be in the balance sheet? Deepak, no, we are not talking about goodwill here because goodwill is an unidentifiable. It is not specifically identifiable intangible. Here I'm talking about identifiable intangibles. Identifiable intangibles. Ishita, they would be in the balance sheet, right? So so if they're in the balance sheet, they're already part of this 1000 and this 1100. I'm talking about intangibles, identifiable intangibles, which are not part of the balance sheet. Okay. So here, one very simple example that was given in the book also is your customer database, customer list, or customer database. That's an identifiable intangible which is not in your balance sheet, right? But it is a huge intangible asset for your business. Similarly, let's say contracts in pipeline. Contracts, if you have, let's say $5 million contracts in pipeline, which are just to be, executed. These are not reflecting in your balance sheet, but these are huge intangibles, right? So you may have millions of dollars of identifiable intangibles which are not appearing in your balance sheet. Okay. So anyways, so let's say, so if I break this down, you paid 1000 for the book value. You paid another 100 extra for the book value to fair value difference. Let's say you paid another 200 extra for the identifiable intangibles. But you still paid 1400. Why did you pay the remaining 100 extra for goodwill? This is the breakup of the 1400 that you paid to acquire 100% shares of this company. Okay. So the difference between equity method and acquisition method is here the identifiable intangible is not there. Here you only have the book value, the fair value, book value difference. That's it. And the rest is goodwill. Here you have book value, fair value, book value difference, identifiable intangibles, and then the rest is goodwill. Yes. Everybody, can I get a quick confirmation? Have you understood this? Everybody, please. All right. So now if you see here one more time, entities fair value, acquired entities fair value over the fair value of entities net assets, including identifiable intangibles. And then whatever is left, excess is goodwill. But in the equity method, it is only the purchase price over the fair value of the net assets acquired. The excess is goodwill. Right? The only difference is identifiable intangibles are not there in the equity method. Now, maintaining goodwill, the cost of this we have already seen. The cost of maintaining goodwill, developing or restoring goodwill is not capitalized, right? They are not capitalized, they are expensed. So now, as we discussed, indefinite life intangibles are not amortized. They are only tested for impairment. So right now we are talking about indefinite intangibles other than goodwill, because goodwill impairment is a slightly different treatment. We are right now talking about other indefinite life intangibles, okay, not goodwill. So intangibles with indefinite useful life must be tested for impairment at least annually. That means at least once a year, minimum. You can of course do it more often, more frequently, but you need to do it at least once every year. So first is qualitative assessment, qualitative, and then of course there is quantitative. Now, entity assessing indefinite life intangible for impairment can choose to first perform a qualitative assessment. Choose to first perform a qualitative assessment. That means before you start doing your quantitative impairment, calculations, you can choose to do the qualitative assessment to determine whether it is more likely than not. More likely than not means more likely than not. It's a phrase. More likely than not is always written together like this. It is one phrase. Okay. So more likely than not means more than 50% likelihood. Likelihood of more than 50%. So qualitative assessment will help you in determining whether there is a more than 50% likelihood that the indefinite life intangible is impaired. Right? It will help you in determining whether there is a more than 50% likelihood of the intangible having been impaired. The entity should assess all the relevant events and circumstances that could affect the fair value of the asset. So cost factors such as increase in raw materials, labor, other cost, right? Cost factors, financial performance, negative or declining cash flows, then legal, regulatory, contractual, political, business, or other factors, other relevant entity-specific events, such as changes in management, changes in key personnel, change in strategy, change in customers, contemplation of bankruptcy, litigation, industry and market considerations, deterioration in operating environment, increase in competitive environment, decline in market multiples, change in market demand of entities, products, and services. Then macroeconomic conditions, such as deterioration of general economic conditions, capital access limitations, fluctuations in foreign exchange rates. That means basically, if you see any kind of adverse effect on the business, right, will help you in determining whether there is an impairment in your indefinite life intangible. So the quantitative impairment test described below is not necessary. Quantitative test not necessary if after assessing relevant qualitative factors, it is determined that it is not likely that the asset is impaired. That means, all these negative trends are not there. Everything is positive, right? Then you don't have to do quantitative impairment test, right? So you may first choose to do qualitative. If qualitative indicates that there could be impairment, more than 50% likelihood, then you do the quantitative testing. If qualitative tells you that no, there is no, more likely than not scenario, then you don't have to do the quantitative testing. Entity has an unconditional option to bypass the qualitative and move directly to quantitative. Of course, they have that choice. They may just forego the qualitative testing. They can simply directly come to the quantitative testing also if they want. Unconditional option to move directly to quantitative testing. So what is the quantitative testing? When testing an indefinite life intangible asset other than goodwill, it is generally not possible to estimate the total future cash flows expected to result from the use of the asset. because it is indefinite life. So you don't know how much life to consider to calculate the expected future cash flows. Should I consider expected cash flows of next 5 years or 10 years or 15 years or 20 years? I don't know, because it is indefinite life. So therefore, an intangible asset with indefinite life is tested for impairment at least annually by comparing fair value of the intangible to its carrying amount. And here, of course, fair value obviously is not PVFCF, because PVFCF is not possible to calculate. So if asset's fair value is less than carrying amount, impairment loss is recognized in the amount equal to the difference. That means there is only one step impairment. It is not two steps. It is only one step. Step one, compare the carrying value and the fair value. If the carrying value is more, fair value is less, that is your impairment. The difference is your impairment. Okay. Impairment loss is equal to the difference. Equal to difference of what? Difference between fair value and carrying amount. If assets fair value is less than carrying amount, fair value is less than carrying amount, impairment, the difference is impairment loss. Okay, so only one step impairment testing. Optional qualitative test. First, if you want to do the qualitative test, you do that. So technically this can become your step one. I mean, let me put it as Roman 1. Or you can, after Roman 1, you can come to Roman 2. If Roman 1 indicates impairment, or you can directly come to Roman 2, right? And in this, there is only one step. If the carrying value, so positive means fair value is more, carrying value is less, then there is no impairment, right? But negative means carrying value is more, fair value is less, right? Then there is impairment. And impairment is the difference between carrying value and the fair value. That's it. That's your impairment loss. So this is actually simpler than impairment of finite life intangibles. And here restoration is not permitted. See, here there is no concept of held for use, held for disposal, right? Because these are not specifically identifiable and they have an indefinite life. Sorry. So recording an impairment loss, impairment loss is reported as component of income from continuing operations. The carrying amount of the asset is reduced by the amount of impairment loss. Restoration is prohibited unless asset is held for disposal. Now here, of course, if it is unless asset is held for disposal. Now here, of course, if it is specifically identifiable intangible, then you can apply this concept of asset is held for disposal or not. If it is not, then you can't. But yeah, not specifically identifiable intangible is typically goodwill, and goodwill impairment has been covered separately over here. So like other intangibles with indefinite useful life, goodwill is tested for impairment at least annually. Goodwill is calculated at the reporting unit level. So now see, goodwill impairment is slightly different. Here it has two steps, but it is at the reporting unit level. Reporting unit is an operating segment or one level below the operating segment. So guys, I hope you remember the concept of components, then operating segment, and out of the operating segments, which ones are reportable segments, right? In segment reporting, we had covered this. So here you had done the concept of operating segment. So for goodwill impairment, what you see is at the operating segment level or one level below the operating segment level, which is called the reporting unit. So goodwill of one reporting unit may be impaired, while goodwill for other reporting units may or may not be impaired, right? So let's say, Unilever has different segments. It has, let's say, cosmetics. It has ice creams. It has beverages, right? It has toiletries. Different types of segments it has. Now, the goodwill of ice cream segment may have gone down, but the beverages and toiletries and cosmetics may not have. Right? So goodwill for one reporting unit may be impaired, while the goodwill for other reporting units may not be impaired. This is all part of Unilever. Unilever, right? We are not talking about overall Unilever goodwill. We are not talking about overall Unilever goodwill. We are talking about at the reporting unit level. This is a reporting unit. This is another reporting unit. This is another reporting unit. This is another reporting unit. So we are talking about reporting unit, which is an operating segment or one level below operating segment. So how do you calculate impairment for goodwill? First is, of course, qualitative and then quantitative. And here also you have an unconditional option to move directly to quantitative. So entity assessing goodwill for impairment can choose to first perform qualitative testing, assessment, right? And here also the same concept applies of more likely than not. Likelihood of more than 50%. The entity should assess all relevant events and circumstances that could affect the fair value of goodwill. Quantitative impairment test is not necessary, right? So quantitative is not necessary. If after assessing, it is determined that it is not likely that goodwill is impaired, right? So same concept. Now the quantitative is carrying amount of the reporting unit, including goodwill, and fair value of the reporting unit, including goodwill, they are compared. If the carrying amount exceeds fair value, there is impairment. Impairment charge cannot exceed the value of the goodwill that is allocated to the reporting unit. Very important line. Impairment charge cannot exceed the value of goodwill. So what we are trying to say here is that carrying value of the entire reporting unit, and obviously the reporting unit includes the goodwill of the reporting unit. So carrying value of the entire reporting unit, including its goodwill. What is the carrying value of the reporting unit? Including its goodwill, okay? And what is the fair value of the reporting unit? Including its goodwill. What is the fair value? Now, if you see that the carrying value exceeds the fair value, suppose this is 100 and this is 80. So carrying value exceeds the fair value by 20. But the next line says impairment charge cannot exceed the value of the goodwill. So now if the value of the goodwill is suppose 15, impairment cannot be more than 15. Okay, impairment charge cannot exceed the value of the goodwill. So if goodwill is 15, impairment cannot exceed 15. Although the calculation is showing 20, impairment cannot be more than 15. But this is, okay, let's first complete it, then I will come back to this example again. Okay, PCC, I'll just come to PCC little later, private company accounting alternative. Let's do this example first. Omega has two reporting units, alpha and beta, which have book value including goodwill of 500 and 675. Right, so let's write it here. Let's solve it ourselves. Alpha, beta. Book value means carrying value, right? Carrying value of alpha, including its goodwill, is 500,000. And this is 675,000. Alpha reports goodwill of 50,000, beta reports goodwill of 75. Now this alpha's 50,000 goodwill is already included in this 500,000. Beta's goodwill of 75 is already included in this 675,000, right? Because this is the complete carrying value of the entire reporting unit. So obviously the reporting unit value already includes the goodwill value, okay? But we can still write it somewhere separate from the calculation. Goodwill 50 and goodwill is 75 here. Okay. Now we are going to compare the carrying value with the fair value. Omega determined fair value including goodwill of alpha 480 and this is 700. Now see, in case of alpha, the carrying value is more by 20,000. In case of beta, the carrying value is less. So we are not concerned because there is no impairment. No impairment. No impairment, right? So we are not concerned further. We will stop here. No impairment. In case of alpha, there is impairment. And impairment cannot be more than the value of goodwill. Goodwill is 50, which is more fine. That means impairment loss is 20,000. If goodwill was 15,000, for example, then impairment loss would have been maximum 15,000. Okay. For alpha, there is goodwill impairment. For beta, it is not impaired. Right? So beta, we are not concerned. We will stop there. But for alpha, there is goodwill impairment. And impairment is 20,000. And because 20,000 is less than the goodwill of 50, the full 20,000 will be recognized as impairment loss. Clear? As I said, this 20,000 is less than goodwill 50,000. So entire 20,000 is impairment loss. Impairment loss cannot exceed the value of goodwill. Okay. Entry, debit loss due to impairment, credit goodwill. All right. R&D costs. I'll just take your questions after this. R&D cost. We just mentioned that R&D cost is expensed under US GAAP, right? US GAAP does not allow R&D to be capitalized. There is one exception to this. I don't know if you remember this when we were doing consolidation. the when we were doing consolidation, the investee company, okay, if they had any in-house R&D, that was an exception to this rule. But anyways, we'll talk about consolidation when we go to consolidation. Right now, let's understand the general rule first. The general rule is that R&D costs are expense. So research is planned effort of a company to discover new information that will help either create a new product, service, process, or technique, or significantly improve the one in current use. Right? So discover something new or significantly improve something which is existing. Improve current, right? Development takes the findings generated by research and formulates a plan to create the desired item or to improve significantly the existing one. Right? So once the research shows positive results, you then start doing the development. Right? You actually create something or significantly improve an existing product. Right? So accounting, only acceptable method of accounting for R&D cost is a direct charge to expense due to high degree of uncertainty. With three exceptions, there are three exceptions to this rule. Number one, material, equipment, facilities that have alternative future use, right? If they have alternative future use, then what will happen is, now this is a different exception than what I was talking about. I was talking about a different kind of exception which we will talk in consolidation. This is within the general rule. The general rule is R&D costs are expensed. There are three exceptions to that rule, right? So this is the general stuff we are talking about. Of course, in consolidation, we will see that there is another kind of exception, which we'll deal later. Here, we are saying that there is alternative future use. Now, suppose there is a machine that has a 10-year life and it is going to be used, this machine is going to be used for R&D purposes, but the R&D project will last only for 2 years. And then this machine, once the R&D project is over, this machine will be deployed in our regular production, right? For the remaining 8 years of its life, for regular production. So because it has an alternative future use, what will happen is, suppose this machine is $100 and life is 10 years, and let's say straight line method we are talking about. So that means the annual depreciation is 10. So in the first year and the second year, when this machine is being used for R&D project, this $10 in the first year will go to the income statement as R&D cost, as R&D expense, not as depreciation expense. Second year also it will go as R&D expense. Third year onwards, it will go to the income statement as depreciation expense. Is that clear? Materials, equipments, facilities, tangible assets that have alternative future use capitalize and depreciate the asset. Capitalize and depreciate the asset over their useful life, not life of the R&D project. Right? So capitalize and depreciate the asset over its entire 10-year life, not just 2 years. So 100 divided by 10, annual depreciation is 10. But in the first 2 years, when it is used for R&D project, this $10 will go and sit in the income statement as R&D expense, not as depreciation expense. Third year onwards, it will go and sit in the income statement as depreciation expense. Okay? Second, R&D cost of any nature undertaken on behalf of others. Undertaken on behalf of others. So obviously, if you are doing it for someone else has paid you for it, right? Then obviously it is their R&D project. Suppose company A has paid company B to do some research for them. So obviously company A is paying for the research. So in company A's income statement, they will show it as R&D. Company B, which is actually doing the research, will not show it as R&D in their books because it is not their, their R&D project. They are doing it on behalf of someone else. So if they are doing it on behalf of company A, then company A is going to show it as R&D. For company B, it is it's a case of revenue and cost of sales. It's a case of revenue and cost of sales, right? Because they are in the business of doing this. They do R&D projects for others. So it's a research company. They just do research work. They do research and development for others, right? For their customers. So company B, for company B, it's their regular revenue because they're in the business of doing research projects, right? Is that clear? In process R&D associated with purchase of one company by another. This was the exception that I was talking about actually for consolidation. In process R&D or in-house R&D associated with purchase of one company by another company. When you are acquiring another company and there is in process R&D in the investee company, that cost is capitalized, right? So normal rule, R&D cost is expensed. That's the normal rule. R&D cost is expensed. Exceptions, when there is alternative future use, then it is capitalized and depreciated. But during the R&D project, the depreciation amount will go and sit in the R&D expense line in the income statement. When R&D cost is incurred, when R&D costs of any nature are undertaken on behalf of others, then for us, it's a cost of sales. And third, in process R&D, when you are acquiring another company. Consolidation, which we'll talk about in consolidation. Items not considered R&D. These items may be capitalized as part of product cost and may be expensed in an area such as selling and administrative expense, but they will not be classified as R&D. The routine periodic design changes, because they are routine in nature, to old products, market research, quality control testing, reformulation of a chemical compound. These are not R&D. This is your, regular selling and administrative expense. Okay. Materials used in R&D project? Yes. Basically, question is, Julie or July company incurred research and development cost in the current year as follows. Materials used in R&D project. Equipment acquired that will have alternative future use in future R&D projects, 2 million. Depreciation on the above equipment. So we are only going to take the depreciation as R&D expense, not the entire cost of the machine, right? Then personnel cost of persons involved in R&D. Yes, we'll take this. Consulting fee paid to outsiders for R&D. Yes, we will take this. Indirect cost reasonably allocable to the R&D project. Yes, we will take this. So these are the R&D costs, not the entire cost of the equipment, because it has alternative future use. If it did not have alternative future use, then we would have taken the entire cost as R&D cost. Okay. So 4 and 5, 9, 19, 20, 22, $2.2 million. The equipment is not charged to R&D because it has alternative future use. It should be capitalized as a tangible asset and depreciated over useful life. Depreciation expense should be, this is the important line. Depreciation expense should be charged to R&D. So in the income statement, this $500,000 will not appear in the depreciation line. It will appear in the R&D line in the income statement. Okay. All right. Now the next topic is computer software development cost. Now here again, there are two categories. The computer software which is developed to be sold, leased or licensed. For example, Microsoft. Microsoft makes computer softwares to be sold to customers around the world, sold, leased or licensed. Right? So computer software developed to be sold, leased or licensed, there's a separate treatment compared to computer software for internal use. So whether you have developed it internally or you have obtained it from outside, but it is for internal use. It is not to be sold, leased or licensed, right? So there are two things. We are talking about computer software to be sold, leased or licensed, and then computer software for internal use. So let's go one by one. Expense the cost until technological feasibility has been established. Then capitalize the cost after technological feasibility has been established. And up to the point product is released for sale. And third, technological feasibility is established upon completion of the detailed program design or working model. That means basically we are saying that we are breaking it down into three parts. One is tech feasibility got established over here. So whatever cost you incurred from the start of your project till technological feasibility, expense it. After tech feasibility has been established, until it is ready for sale, that means now you go into regular production and you keep selling it. That means you make copies and you give out licenses to people. You make 1 million copies, you give 1 million licenses. So you go into regular production. Once you go into regular production, from this tech feasibility until you go for regular production, you capitalize this cost. And obviously, when you capitalize it, you are going to amortize it also. And the regular production, once you go into regular production, then again, then of course, it becomes your inventory, right? Then it becomes your inventory and becomes basically cost of sale. Then it becomes your cost of sale, cost of goods sold or cost of sale kind of a concept. So these are the three phases: phase 1, phase 2, and phase 3. Phase 3 then becomes a continuous phase. Now, when you capitalize it, you have to amortize it. Amortization will be percentage of revenue or straight line, whichever is greater. Percentage of revenue means you take the total projected. So first you take the total capitalized amount, take the total projected gross revenue for the product, total over its life. So let's take an example. Suppose the total capitalized amount, this phase 2 capitalized amount is, let's say, $100. You are going to earn total, suppose, let's say $100 from this product. In the current period, you have earned $20. So as a percentage of revenue, your amortization for the current period will come to 20. Right? Current gross revenue divided by total projected gross revenue into the total capitalized amount. Straight line is obviously straight line. That means you just divide it by the estimated economic life. So suppose 100 and its economic life is 4 years. So 25. Whichever is greater, you take that as the amortization. And once it goes into regular production, then it becomes your inventory, as I said. So then cost incurred to actually produce the product are product costs charged to inventory. Capitalized software costs are reported at lower of cost or market, where market is equal to NRV, net realizable value. Okay. And net realizable value is also called market ceiling, if you remember. Okay. So this is the diagram. From the idea stage to the technological feasibility stage, expense it. Then from that to the release of the product for sale, capitalize it and amortize it. Of course, amortization will begin from here, from the time it is released for sale. And then after it is released for sale, then it becomes your normal inventory cost of goods sold or cost of sale concept. And amortization is percentage of revenue or straight line, whichever is greater. Now coming to developed internally or obtained for internal use. Here also the concept is very similar, only the term is different. There we were using the term technological feasibility. Here we are using the term preliminary project state. Concept is exactly similar. Expense the cost until the preliminary project state, then capitalize the cost after the preliminary project state. And then of course, once it is developed and you start using it, then it becomes your, then the project is over, then it becomes your regular expense, right? So it is concept wise, it is similar, only the term, instead of technological feasibility there, it is preliminary project state over here. And here also, since you are capitalizing the cost, you are going to amortize it. And here, because it is for internal use, there is no revenue coming from it. Therefore, you are going to use only straight line. There is no question of percentage of revenue here, because you are not going to make any revenue out of it. It is only for your internal use. Therefore, only straight line is allowed. If software previously developed for internal use is subsequently sold to outsiders, right? So initially you thought you are developing it for internal use, but then you thought that, it may have a market, market demand for it. So you started selling it to outsiders, or you sold it to outsiders. Then the proceeds received from the license of the computer software, net of any incremental cost, should be applied first to the carrying amount and then recognized as revenue, right? So this is basically the most conservative form of revenue recognition, where you first apply the proceeds towards the carrying amount and then you recognize any revenue. Okay, this is also referred to as the cost recovery method, right? Proceeds should be applied first to carrying amount, then recognized as revenue after carrying amount has reached zero. So that's it about intangibles, right? Now, one thing, guys, I'm going to do questions with you every week, right? That means whatever topics we'll cover this weekend, I'm going to do MCQs on those in the following weekend. Okay, and of course cover new topics in the following weekend also. So why don't you utilize this week's time to revise whatever we are covering in class during the weekend, which means you have to go through intangibles. And of course, let's see, there is one full hour to go. We can start with revenue recognition. People who have not done FAR, please make sure that you go through the revenue recognition topic, first, then you revise this. Okay. Revenue recognition topic from FAR, I mean, you go through that first and then you come to BAR and revise this. All right. Now, as I said, because it is the first class today, I'm going to quickly walk you through the revenue recognition from FAR. Okay, this is the revenue recognition from FAR, right? FAR 2. So what we covered here is, in order to properly apply the revenue recognition standard, entity should implement the 5-step approach. There are 5 steps before you can recognize revenue. Identify the contract with the customer. Identify the separate performance obligations in the contract. Determine the transaction price. Allocate the transaction price to the separate performance obligations. Recognize revenue when or as the entity satisfies each performance obligation. Right, so there are many things here. It is a slightly tricky topic, revenue recognition. In the first step, identify the contract with the customer. Of course, contract is basically an agreement between 2 or more parties, which is enforceable rights and obligations, right? So it is a legally enforceable agreement. That is a contract, right? Now, the criteria 5-step approach is applied only when a contract with customer meets all of the following criteria. All parties have approved the contract and have committed to perform their obligations, right? All parties have approved and committed to perform their obligations. Rights of each party are identified. Rights of each party are identified. Each party knows what is their right in the contract. Right? So they are committed to perform their obligation. They know their rights in the contract. Payment terms identified. Payment terms can be identified. Contract has commercial substance. Commercial substance, that means it is not a like-kind exchange. It is not a like-kind exchange. Or rather, it is not a non-monetary exchange. That means I am giving you my machine, you are giving me your machine. This kind of transaction lacks commercial substance. Okay, a car for a car, a machine for a machine, whatever. Now, of course, there's a separate topic on like-kind exchanges or non-monetary exchanges. In non-monetary exchanges also, there are 2 categories, those that have commercial substance and those that do not have commercial substance. What we are talking about here are only contracts that have a commercial substance. That means future cash flows are expected to change. The amount of the cash flow, the risk of the cash flow, and the timing of the cash flow are expected to change. That means, let's say A exchanges a building for certain machinery with B. Now here, the amount, timing of cash flows will change, right? The building's insurance amount would be very different from the insurance amount of the machinery. The maintenance of the building would be very different from the maintenance of the machinery, right? The revenue that you will earn from the building, the rentals, will be very different from the revenue that you will earn from the machinery, right? So the amount, timing, risk of cash flow, everything is changing here. It has commercial substance. Even though it is an exchange, even if it is an exchange, it has a commercial substance. Okay. So whenever there will be a change, or at least expectation of a change, future cash flows are expected to change as a result of the contract, that means it has commercial substance. So all the parties have approved the contract, they are committed to perform their part of the obligation, they know their rights, payment terms can be identified, contract has commercial substance, and amount will be collected. It is probable that the entity will collect substantially all of the consideration. And probable means, again, what does probable mean? More than 50% likelihood, right? Probable means more than 50% likelihood. So there is a more than 50% likelihood that you will collect the amount, collect the consideration. So if all these 5 criteria are met, only then will you start applying the 5-step approach. 5-step approach is applied only when a contract with a customer meets all of the following criteria. And this criteria assessment is done at contract inception. If all criteria are met, then you don't need to do reassessments. Reassessment should only be needed if significant changes occur, right? So if at contract inception all those 5 points are met, then you are good to go. You don't need to do any reassessment. Reassessment is required only if there are significant changes. Okay, and if all of the criteria are not met, then of course reassessments are required, right? You will keep on reassessing until you meet all the 5 criteria. These 5 I'm talking about. Right? Then of course we also spoke about combination of contracts, right? That means two or more contracts entered into with the same customer or related parties of the same customer at or near the same time, then contract should be combined. A entered into a contract with B, A again entered into a contract with B around the same time, at or near the same time, then these 2 contracts can be combined into one contract between A and B, right? And accounted for as a single contract. Of course, there were some criteria. There were some if conditions. Then we also studied contract modification. right? Change in price or scope or both, approved by both parties. So this was your step one, basically identify the contract with the customer. Then step two was identify the separate performance obligations in the contract. Right? So if you're delivering, we had done a question on if you're delivering a software, you are also installing the software, you're also giving training to the employees to how to use the software, then you are also going to do its version upgrades. So in one contract, you are doing all of this. There is a software, there is installation of the software, there is training of employees on how to use the software, then version upgrades. Version upgrades for 3 years. Or let's say maintenance of the software for 3 years. Right? So there are separate performance obligations in the contract. Now, so when there are, so what is the performance obligation? It's a promise to transfer a good or a service to a customer. The transfer can be individual good or service or a bundle, individual good or service or a bundle of goods and services. Now, whether this individual good or service or the bundle is distinct or not, is it distinct? If it is distinct, then it is a separate performance obligation, or if it is a series of goods that are substantially the same, then it is not a separate performance obligation. Right? So, in order to be distinct, both criteria below must be met. Promise or transfer is separately identifiable. The promise is separately identifiable. Customer can benefit either from the good or service independently or when combined with customers' available resources. Right? So here we had taken examples of music system and speaker, car and its engine, a phone and its charger. Are these, so when you buy the phone, the charger comes with it. Is it one performance obligation or two separate performance obligations? When you buy a car, the engine comes with it. Is it one performance obligation or two separate performance obligations? Right? So we had discussed these points to determine in which case will it be considered as one performance obligation or two distinct performance obligations. Correct? It is separately identifiable if entity does not integrate the good or service with other goods or service, does not integrate. Good or service does not customize or modify another good or service, does not depend on or relate to other goods or services. Then it is separately identifiable. If they are highly interrelated or interdependent, then they are not separately identifiable. And entity provides a significant service of integrating the good or service with other goods or services promised in the contract. Right? So in these two cases, it is not separately identifiable. So if it is not separately identifiable, then it is one single performance obligation. And if they are distinct, they are separately identifiable, then there are two or three, depending on how many things are there. They are separate performance obligations. Now, when this is an example of when you book a flat, right? When you book a flat, an apartment in an apartment complex, right? Then it is one single performance obligation. It is not like, construction is separate, piping is separate, wiring is separate, installation of equipment is separate, and finishing is separate. It's not like that, right? It is one single performance obligation. When the construction company hands over the apartment to you, then they have fulfilled their performance obligation. They have satisfied their performance obligation, right? They cannot say that there are separate performance obligations, 1, 2, 3, 4, and 5 separate performance obligations. We have satisfied the first one by doing the construction. We have satisfied the second one by doing the piping in the building. They can't say that, right? So although the goods and services provided by the contractor are capable of being distinct, they are not distinct in the contract because they cannot be separately identified from the promise to construct the unit, because you had booked a specific unit. So when you get the unit, then the performance obligation will be satisfied. This is the example I was talking about. There is a software license, installation, software updates, technical support. And customer can benefit from each good or service on its own. Developer has also determined that the software license, installation, updates, and technical support are separately identifiable. So that means they are separate performance obligations, right? So in this case, when the company gives the license to the customer, they can recognize revenue for the license part of the entire contract, right? So the entire contract may be for certain X amount, but they can recognize revenue for this because it is a separate performance obligation. Once they do the installation, they can recognize revenue for this. Once they do the software updates, they will recognize revenue for that. So they can. But in the previous example, the construction company cannot recognize revenue for the construction, for the piping, for the wiring, for the finishing. They can't do that. They have to wait till the end and recognize revenue only in one go. Whereas in this example, revenue can be recognized at different stages because there are separate performance obligations. Of course, we need to know how much of X should be allocated to 1, how much of it should allocated to 2, how much of it should go to 3, how much of it should go to 4. So suppose half X is for first case, then half X can be recognized over here. Okay. Then determine the transaction price. It is the amount of consideration that entity can expect to be entitled to receive. Now here, expect to be entitled to received was was dependent on. So if you remember the example that I had given, the example that I had given was Jan to December. If you can finish the project by December, then customer has said that if you finish the project by December, then we'll pay you $100,000. If you finish it before time, we'll pay you more because time is critical for us. If you delay the project, we will actually penalize you, we'll pay you less. Right? So how much should you consider as your revenue, right? That depends on what you are expecting to be entitled to receive. What you are expecting to be entitled to receive. That means, what is your best guess? That means basically we are saying, take the weighted average, right? Use probability factors and find out the weighted average. If there are multiple options like this, right? This is 120, here it is 80. If there are multiple scenarios like this, then take the weighted average. And if it is only 2 or 3, not many options, then you take the best case scenario, right? So we had discussed that part. Then of course there was variable consideration, and variable consideration only, this example was on variable consideration only, that if it is the expected value, means probability weighted amounts, or if there are not too many options, then the most likely amount. But if there are too many scenarios, too many options, then you take the probability weighted amount, right? Then of course another aspect in revenue recognition was financing. For that we had done an example from the book. This example number 3 was on significant financing. Jan 1, year 5, SDF sold furniture to a customer for 4,000 with 3 years interest-free credit. 3 years interest-free credit. That means Jan 1, year 5, it was sold. Jan 1, year 5, it was sold. This is the first year, second year, third year. You will get the money on December 31. So this is year 5, year 6, year 7. December 31, year 7, you will get the money, right? You will get 4,000 on December 31, year 7. But you have sold the furniture today on Jan 1, year 5. So how much should you recognize as revenue? You take the present value. In this question, present value will be calculated based on 8%, right? And as you can see here, based on 8%, the present value comes to 3,175. So you will take 3,175 as your revenue, not 4,000. The difference between 4,000 and 3,175 will be the interest spread over 3 years. There will be interest of year 1, interest of year 2, interest of year 3. These 3 amounts will total this difference of 4,000 and 3,175. So 825, right? This total year 1, this year 1, basically year 5. Year 1 is year 5 over here. Year 5, year 6, year 7, interest will total 825. So year 5 interest is 254, then 274, then 296. Let's just add it over here. 254, 274, and 296. 14. 824. Yeah, 824, 825, pretty much. Yeah, rounding off. Right? Only 3,175 is revenue. The rest is all interest, because there is a significant financing element involved in this transaction. Then there was step 4, allocate the transaction price to the performance obligations in the contract, right? And that you do based on the standalone selling prices. So the discount is also allocated proportionately. So let's look at this example. So a software company enters into a 250,000 contract with customer to transfer software license. Let's do it ourselves over here. Software license, installation, technical support. Technical support is for a 3-year period. 3 years. License is usually sold for 160. Installation service is 20,000. And technical support is 30,000 per year. So for 3 years, it will be 90,000. So the total is coming to 270, but we have paid only 250 because we have taken all the 3 things from the same company. So they have given us a discount of 20,000 overall. Now the question is, how much of this 250 should be allocated to software? How much should be to installation? How much should be to technical support? So simple answer is simple, 16 by 27 or 160 by 270 into 250 should go to software. 2 by 27 into 250 should go to installation, and 9 by 27 into 250 should go to technical support. Right? That is how you allocate the transaction price to the separate performance obligations in the contract. Right? So as you can see here, 160 by 270 into 250,000, 20,000 by 270 into 250,000, 90,000 by 270 into 250,000. And finally, step 5 was recognize revenue when or as the entity satisfies the performance obligation. Right? So you have identified the contract, you have identified the separate performance obligations in the contract, you have determined the transaction price, you know how to allocate the transaction price over the separate performance obligations. Now you are on step 5, recognize revenue when the entity satisfies a performance obligation or as the entity satisfies a performance obligation. When means at a point in time, at a point in time. As means over a period of time. Here, the example that we had considered, I'll write here, the example that we had considered was, this is an apartment complex getting constructed. There are multiple towers over here, right? Multiple towers over here. You have booked one apartment in one tower, right? This apartment you have booked on the 10th floor of this building, right? You have booked this apartment. Now, when the construction company delivers this apartment to you, they can recognize revenue. They cannot recognize revenue when construction is done, when piping is done, when wiring is done, when all that finishing is done, when painting is done, all that. They cannot. They have to recognize revenue at a point in time. When they hand over the keys to you, when the registration happens in your name, right? That is when they can recognize revenue at a point in time. Compared to this, another example was, you have a house which has 2 floors, ground and first. Now you have appointed a construction company to build the second floor for you. In this case, as the construction company keeps doing the job, they can keep recognizing revenue on a percentage of completion method, right? This is more like a completed contract method. This one, at a point in time, completed contract method. Whereas this one, the construction company can recognize revenue as they keep performing. So if they have done 25% of the work, they can recognize 25% of the revenue. Next year, they have done 50% of the work, they can recognize 50% of the revenue, etc. So this is the basic difference. This is a case of over a period of time, right? And this first one was at a point in time. The second one is over a period of time. So these were the basics of revenue recognition, right? Satisfied at a point in time where control is passed on to the customer. Control means entity has right of payment, customer has obligation to pay. Customer has legal title to the asset, entity has transferred physical possession of the asset, customer has significant rewards and risks of ownership, customer has accepted the asset. When these conditions are met, that means control has passed on to the customer at this point in time. When the legal title has transferred, when customer has accepted the asset, physical possession has been transferred, rewards and risks and rewards of ownership has been transferred, etc. So control has passed on at a point in time, right? Over a period of time, this is over a period of time. 3 points. Entity's performance creates or enhances an asset. Creates or enhances an asset, right? So you already had an asset. Now the entity's performance is enhancing this asset, right? The second floor. It is enhancing an existing asset, right? Or creating an asset could mean that you have the land, it is your piece of land, and now they are constructing the building for you on this land, right? It is your land. That is also an example of satisfied over time. Customer simultaneously receives and consumes the benefits. Here, an example is, every newspaper, 365 days, the newspaper vendor delivers newspaper to you. Every day when they deliver the newspaper to you, you read the newspaper, you consume it. Next day, again, they deliver, again, you read it and you consume it. Consume means obviously you don't eat it. Consume means you have derived the benefit from it, right? So here also it is satisfied over time. So now if they are taking, let's say, $365 from you for the entire year, at the end of January they can recognize $31 as their revenue. At the end of February they can recognize $28 as their revenue, right? It is over a period of time. Entity's performance does not create an asset with an alternative use to the entity, and the entity has enforceable right to receive payment for performance completed to date. That means there is no alternative use to the entity. Obviously, if it is your land and they are constructing the building for you, they don't have an alternative use. They can't do anything with this building because it's your building, it is standing on your land. Whereas in the apartment complex situation, where there were multiple towers, if later you decline to buy, you had booked a flat, but you declined to buy, they can always sell this apartment to someone else. But in this case, they cannot sell it to someone else because it is your land, it is your building. So they don't have an alternative use. So that is another condition, okay, of satisfied over time. But yes, all conditions need not be met. Even if any one condition is met, it is satisfied over time. All right. Then of course you need to go through the video for, maybe better clarity. This was a quick recap for people who have done FAR. For them also it's a quick recap. People who have not done FAR, for them of course it's the basic learning of revenue recognition. So now I think we are in a position that we can go to the bar revenue recognition and start. All right. So they have kind of given some part of it here, reproduced it here so that people can understand it. So this is something we have already covered here. Revenue recognition occurs when an entity satisfies a performance obligation by transferring a good or a service to a customer, right? Satisfies a performance obligation by transferring either a good or a service to a customer. Revenue should be recognized at an amount that reflects the expected consideration. Expected consideration entity is entitled to receive. All entities that either enter into contracts with customers to transfer goods, service, or non-financial assets are subject to revenue recognition standard. Of course, leases are covered. Leases, insurance, non-warranty guarantees, financial instruments are covered under other standards. So they are not covered here. 5-step approach. We have already discussed the 5-step approach. Very quickly, step 1, identify the contract with the customer, identify the separate performance obligations in the contract, determine the transaction price, allocate the transaction price to the separate performance obligations, recognize revenue when or as the entity satisfies each performance obligation. Right? Construction contracts, revenue recognized over time versus at a point in time. So this I have already explained to you. Over time, if any one of the criteria below is met, the entity's performance creates or enhances an asset that the customer controls. Now, in this land example or this building example where there were already 2 floors, and now you have appointed a builder or a contractor to construct the second floor for you. Ground first was already there, you have appointed them. So now here see, it is enhancing an asset that you already control. Customer, you are the customer. Customer already controls this asset. Okay. Number 2, entity's performance does not create an asset with alternative use to the entity. Does not. Here, it does not create an alternative use to the entity. Entity means the construction company or the contractor. The contractor is the entity, and let's say we are the customers, right? We have appointed this contractor. So the contractor is working for us. Now the contractor does not have an alternative use, right, of this. That means, let's say after 40% work, if we say, sorry, we don't want to work further with you, can the contractor do anything with this second floor? No, they cannot, because it is an asset that we control. It is on our land, it is our building, right? So contractor does not have an alternative use. So the contractor, yes, of course, the contractor is entitled to his or her money for this 40%. Of course, they are entitled to their money. You cannot deny that. They are entitled to their consideration. But can they do anything with this asset? Answer is no. Right? So therefore, recognized over time. Right? Either it enhances an asset that customer already controls. That condition is also getting satisfied over here. And contractor does not have an alternative use. That condition is also getting satisfied over here. Is that clear? Does not create an asset with alternative use to the entity. So let's look at this example. Tanner is building a multi-unit residential complex. Entity enters into a contract with a customer for a specific unit that is under construction. Contract has the following terms. Customer pays a non-refundable security deposit upon entering the contract. Customer agrees to make progress payments. If customer fails to make progress payments, entity has the right to all of the consideration in the contract if it completes the unit. Terms of the contract prevent the entity from directing the unit to another customer. Prevent the entity from directing the unit to another customer. That means they don't have an alternative use. They can't sell it to another customer, right? So either Tanner will buy it or they cannot sell it to another customer. That means they don't have an alternative use. Therefore, answer is, should they recognize revenue at a point in time or over a period of time? Answer is, they should recognize revenue over a period of time, because this contract is creating an asset it is creating an asset, and the entity does not have alternative use. Okay, so it is recognized over time. Let's look at the answer. The performance obligation is satisfied over time because unit does not have alternative future use to the entity, because it cannot direct it to another customer, and entity's performance creates an asset. So both the conditions are met. Using input methods. Okay, so there was something called input method and output method over here in revenue recognition. Let me quickly take you through that. So see, when you recognize revenue over a period of time, you can use output method, input method. There are two types of methods, output method, input method. But I want to read the last line first. When the output used to measure progress are not available, input method may be necessary. That means the preference is use the output method first. When the output method is not possible, when the outputs used to measure progress are not available, then input method may be used. That means this is your first priority. If you don't have this, if not, then go to input method. Now, basically, what does this mean? Output method means, you are recognizing revenue over time. Remember the example of newspaper. You have to deliver 365 newspapers during the year, and the customer will pay you $365. So at the end of January, you have already delivered 31 newspapers. So you can recognize 31 by 365 into 365. That means you can recognize $31 as your revenue. How did you know that you can recognize $31? By using the output method, right? Your final output is you have to deliver 365 newspapers during the year. That's the output. How much of the output have you delivered? 31. Therefore, you can recognize $31, right? So units delivered, units produced or units delivered. Or let's say time elapsed. Let's take another example of time elapsed. You have taken a membership in a health club, right? And the health club charges $100 per month. So when January ends, they can recognize $100 because time has elapsed. January month has elapsed. When February gets over, they can recognize another $100 because time has elapsed. So time elapsed is another method to determine how much revenue you can recognize. Third is milestones achieved. Milestones achieved, right? Milestones could be civil work done. Next, plumbing done. Electrical work done. Then maybe tiling done. Then kitchen is done, the modular kitchen. Then the flooring is done, or maybe flooring will be included in tiling. Finally, let's say painting is done. So these are milestones. As you reach the first milestone, you can recognize some revenue. When you reach second milestone, so this is also one of the output methods, milestones achieved. Now, of course, in which case can you recognize revenue? In the case of the land where you already had the building and the contractor was doing the second floor. So you have to read it in the context. In the case of the multi-unit residential complex, where if you don't buy it, they can sell it to someone else. In that case, you can't do this. In that case, it is at a point in time. They have to deliver the apartment to you to recognize revenue. In that case, they can't say that we have done the civil work, we will recognize this much, we have done plumbing, so we will recognize this much. They can't do that. So you have to understand it in the context of the overall scheme of things. Is that clear? Then survey. If the surveyor says 25% work is done, then you can recognize 25%, right? So based on survey, or appraiser says, based on appraisals. So there are registered appraisers who do the appraisals for, particularly, construction sites and all that. If you don't have any of these available, then you can do the input method. Input method, things like cost incurred relevant to the total expected cost. So to construct the whole building, it will take you $100 cost, and you have already incurred $30 cost. That means you can say that 30% work is done. Based on the cost incurred, you can say how much percentage of work is done. Okay. Resources consumed. It will take you 10 man days to finish the job. You have already done 6 man days. That means 60% work is done, right? So that is also another input method. Labor hours expended, right? Similar to resource consumed. Time elapsed. Time elapsed appears in both the places. Time elapsed is both an input method as well as an output method. Okay, so let's go back to the bar. Using the input methods, when a long-term construction contract meets the criteria for recognizing revenue over time, when it meets the criteria, overtime criteria. Overtime criteria was which example? It was your land, it was your building. This was the over a period of time example, correct? And it is expected to be profitable. It is appropriate to use an input method such as cost to cost incurred relevant to the total expected cost. If the entity's accounting system can reasonably estimate profitability and provide a reliable measure of progress. So that means you should know, okay, what is the contract price? Suppose 1,000. What is the total cost going to be? 800. That means what is the estimated profit in the entire contract? 200. So this is condition number 1. You should be able to estimate your profitability. Right? This point number 1. Point number 2 is you should be able to measure your progress. Have I completed 25% work? Have I completed 40% work? How much work have I completed? You should be able to measure your progress. If you can do both these things, you can estimate your profit and you can measure your progress, then you should recognize revenue over time. Of course, if the criteria is met. When the criteria is met, then you can recognize revenue over time using an input method. Using an input method. Okay. So income, determination of revenue recognized, income recognized is percentage of estimated total income that incurred cost to date bears to the total estimated cost, or such other measure of progress towards completion appropriate to the work performed. So let's talk about this. Let's continue with that example. Contract price is 1,000. Cost is 800. Therefore, estimated profit is 200. Now, in the first year, cost incurred is 200. Now, if the first year cost incurred is 200, that means cost incurred divided by the total cost is 25%. That means 25% work is done. If 25% work is done, we can recognize 25% of the total profit. Total profit is 200. We can recognize 25% of this, which is 50. Right? So you can use this method. Of course, if the condition, when the criteria is met, only then you can use the input method to recognize revenue, provided your accounting system can estimate profitability and measure progress towards completion. So you can estimate profitability, you can measure your progress by using the input method, so you can recognize profit. Right? Recognize income. Balance sheet presentation: when long-term construction contract revenue is recognized over time, construction cost and estimated gross profit are accumulated in the construction in progress account, which is an inventory account, and billings on construction are accumulated in the progress billings, which is a contra inventory account. That means what we are saying in simple words, if this is your balance sheet, you have already incurred 200 as cost. So that's your construction in progress. And your progress billing, if you have already received, for example, if you have already received 150 from the customer as progress billing, then that's your less progress billing is your contra inventory account. Contra. Okay. The two accounts are netted against each other for balance sheet reporting. Netted against each other. Right? The construction in progress and the progress billing. All right. Journal entries and interim balance sheet treatment are same as they are for construction contract revenue recognized at a point in time. So journal entries are same. Calculation is this. You take the contract price, you take the estimated total cost, you get the estimated profit. Then in the first year, suppose this is the cost you have incurred divided by the total estimated cost, you get the percentage. Then you multiply the gross profit, step 1, into the percentage that you calculate in step 2 to get how much profit you can recognize during the current year. I mean, what is the profit that you can recognize overall? And then that minus whatever profit you have recognized in the earlier periods, the difference between the two is the current year profit that you can recognize. Right? Now, of course, you will understand this better through an example. Okay, example is not here. Wait, let me see. Yeah, this is an example over here. Sale price 4,000. Total estimated cost is 3,000. That means first step is what is the profit? 4,000 minus 3,000. 1,000 is the estimated profit. Now step 2, how much work have you done? 1,500. That means 1,500 divided by total cost is 3,000 into 100. That means 50% work is done. Step 3, step number 1,000 into step number 2, 50%. This is the profit you can recognize. Step 4 is out of 50, has anything been recognized in the earlier periods? Answer is no. So therefore, entire 50 can be recognized in year 1. Now we come to year 2. Year 2, again, we do step 1. Sale price 4,000. minus total estimated cost is 3,200 now. So estimated profit is 800 now. Step 2, how much work is done? Cost incurred to date 2,400. That means 2,400 divided by 3,200 into 100, which is how much? 3/4, right? So 3/4 means 75%. So step number 3 is step number 1, 800 into step number 2, 75%. That means 3/4 of 800, 600. Step number 4, out of 600, out of 650 has already been recognized in the first year. So 550. Wait, let's just quickly confirm. 75%, 600. Oh, sorry, this first one. Sorry, first one is 50% of 1,000. It is 500. Yeah, sorry. So second year would be 600 minus 500. Only 100 will be recognized in the second year. Okay, I hope you're following this, everyone. Now third year. In the third year, again, you will do step 1. Step 1, contract price 4,000 and cost is 4,200. Now there is a loss of 200. Okay, it's a loss amount. Now, when it comes to loss, you don't see percentage. You follow the rule of conservatism. You book the entire loss immediately, right? Whether 70% work is done, 80% work is done, 100% work is done, 20% work is done, whatever. You don't look at the percentage, you book the entire loss immediately. So this becomes not applicable. Now you have to book the loss of 200. You have already booked a profit of 600, 500 in the first year, 100 in the second year. You have booked a profit of 600. You have to book a loss of 200. That means in the third year, you have to book a loss of 800. Okay, I hope this is clear to everyone. In fact, this is not step 3. 1 second. Step 3 is 200. You have to book the entire loss. Step 4 is if you have to do minus 200 minus 600, that is minus 800. That means you have to book a loss of 800 in the third year. Okay. Fourth year, again you do step 1, 4,000 minus 4,300. It's a loss of 300. Step 2 is not applicable because it's a case of loss. Step 3, you have to book entire 300 loss. Step 4 is out of 300, you have already booked a loss of 200. So now you have to book a loss of only 100. Sorry, minus 300 minus 200, which makes it plus 200. So our final answer, year 1 is 500. Year 1 is 500. Year 2 is 100. Year 3 minus 800. Year 4 minus 100. Let's look at the answer. 500, 100, minus 800, minus 100. Okay, let me take a pause here and just look at your queries. And then of course in tomorrow's class, if the concept is not clear, then I'll do a repeat of this. Don't worry. I'll not proceed unless concept becomes clear to all of you. So let me take your questions quickly. Okay, I'll go in the backward direction. Okay, so Can you please explain the minus? Can you please explain the 500 and then why 800 loss? Okay. See, 500 is because you had 50%, right? This you understand. Step 1, 4,000 minus 3,000, 1,000 is your profit. Estimated profit, of course. You have done 50% work. So therefore 50% of 1,000 is 500. And because this is the first year, you have not recognized anything in the past, obviously because it's the first year. So you recognize the entire 500 in year 1. Now when you come to year 2, you do your calculations again. Profit is 800. You have done 75% work. 75% of 800 is 600. So at a cumulative level, see, at a cumulative level, you have to recognize 600 profit. But out of 600, you already recognize 500 in year 1. So in year 2, you will recognize only 100. Now cumulatively, you have recognized 600. Right? Now cumulatively, you have recognized 600. Got it? Third year. Third year, you again do your calculations. It is coming to a loss of 200. So step 2 becomes not applicable. So you have to recognize entire 200. Now at a cumulative level, you have to recognize 200 loss. So at a cumulative level, if you have to recognize 200 loss, you had recognized 600 profit. So you have to reverse that profit and book a loss. So reverse the profit and book a loss. So when you reverse the profit of 600, it is negative 600, and then you book a loss of 200. So it is negative 800. Make sense? Finally, in year 4, there is a loss of 300. So therefore, you have to book the entire 300 at a cumulative level. Out of 300, you have already, cumulatively, you have already booked a loss of 200. Because in year 3, you booked a loss of 800. So cumulatively, you have booked a loss of 200. Because positive 5, positive 100, negative 800. Cumulatively, you have booked a negative 200. Now you need to book overall negative 300. Therefore, in year 4, you just need to book a negative 100 to make it cumulative 300. Now, is it clear? Got it? Okay, great. So I guess Ishita, Deepak, Shivangi, your queries are sorted. Deepak, you are anyways calling me on Monday for your audit queries. So you can also, we can also discuss your, bar queries, right? So I guess that's it. Anybody else? Have I missed your question? No, I think I've covered everybody's question. Deepak, please give me a call on Monday. I'll discuss both your audit queries and bar queries in the same call. And if you have any queries from FAR, we can discuss that as well. Okay. So guys, thank you so much. I'll see you tomorrow evening. Okay. For bar, and of course, if you're doing audit, then tomorrow morning for audit. Thank you. Thank you, guys.